Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
In this session, people, I'll be looking at 2019, that's me, 2019 Principles of Accounts, number 1, response. And just to note, it is a balance sheet. So it's another lesson on completing the statement of financial position, but this time it is a worded question. So let us take a look at the question. I know for candidates, you rather getting a list of balances where you're asked to prepare the financial statement. But in this case, people, you have to analyze and identify the items in order to prepare the statement of financial position for Simone Cook. The question reads, Simone Cook is a producer of natural juices. On January 31st, 2018, she provided the following information about her assets and liabilities. And you can see that there are a list of statements with information relating to Simone Cook. Additional notes was also provided, and you are required to use all the information provided above to prepare a classified statement of financial position. And we're talking about the balance sheet for Simone Cook in vertical style as at 31st of January 2018. You're to use the order of permanence in classifying the assets, and note you're asked to show the working capital clearly. If it is that there is any decimal, you are asked to round off all workings to the nearest whole number. So what we're going to do now is to look at each statement and assess them to pick up the item as well as the value. There is inventory of frozen beverages. So we're looking at the first one, inventory of frozen beverages on hand valued at $50,000. No, clearly we're seeing that is inventory and the value is 50,000. So let us make a note of that on our worksheet. Inventory, the value is $50,000. Let's move into the second information there that is provided. Second statement, Simone Cook owns an industrial blender valued at $200,000. So remember, she is running a natural juice business. So this blender basically will be fixed asset when we're doing the balance sheet. So that is blender. We could just write industrial blender and the value is $200,000. Next statement, which is the third one, let me highlight that for you. A delivery van was bought at a total cost of $140,000. So we have delivery van of $140,000, and that was purchased on the 3rd of January. Now you may be wondering why I'm stressing this, because additional information is provided and you have to be very careful when you extract the information. Simone used a 6-year, 20% per annum loan of $60,000 from Optimum Beverage Financing Limited. So what they're saying is that Simone used this loan of $60,000 to pay on the delivery van that she has purchased. Possibly it could have been that she paid the rest using cash that she had, or it could state that it is owing. That information is not provided to us, but what is provided is that the delivery van is $140,000. There's a loan of $60,000, which is a long-term loan because it is 6-year, and there is interest that is paid per annum, which is 20%. So what we're going to make note of is that there is a delivery van. The value of that is $140,000, and there is a 20% 6-year loan, and the value for that is $60,000. Let's move into the other statement that is provided to us. Tea farmer who promised to supply some apples for the apple nectar blend was paid $9,000 in advance by Simone. Basically, people, because there's advance payment, this is prepayment. Simone had paid for something that she has not yet used up. So once that is done, it is prepayment. It is Simone's money that is in the hand of tea farmer. So you'll find that when we're doing the balance sheet, this prepayment will form a part of the current asset. So let's make a note of our prepayment on our working sheet. When you're doing questions like this, people, you are advised to extract the information first. Highlight what is important before you do your actual working. And the prepayments is $9,000. And we're going to continue to extract the information from the question. Simone Cook owns refrigerators valued at $95,000, and that is clear. Simone would need a fridge. She would need fridge to store the juices. So this refrigerator, basically, when you're doing the balance sheet, will form part of your fixed asset. So let's make a note that we have refrigerator. Simone has refrigerator of $95,000. Again, that value is $95,000. And we are going to continue to extract the information from the questions. It's easier for us to do our balance sheet when we get there. Health Food Store was supplied with products on credit valued at $10,000. But guess what? The company promised to settle in March 2018. So this is clearly saying to us that goods were sold on credit. So at this stage, because this person is owing, Health Food Store is owing Simone, it means that this is going to be classified as trade receivables, also known as your debtor or even accounts receivable. So on our worksheet, we're going to make a note that we have trade receivable, and the value for trade receivables that we have is $10,000. Let's continue. We're going right back to the question to extract all the details before we prepare our balance sheet that we're asked to prepare. There is rent of $20,000, but guess what? This is outstanding for the month of January. This is expenses that is not yet paid. It is expense that is accrued. So therefore, that is accruals. So on our worksheet, you can call this accruals. And the amount, or I could say rent accrued, amount is $20,000. Let us continue because there is more details for us to extract based on what we are seeing. So we're going to continue to extract that. And we have Ultimate Muscle Builder Limited owes Simone Cook $15,000 for goods used to host an exercise symposium. Again, we're seeing that there is someone else that is owing Simone. So we have more for the debtor right there. So we're going to go over on the worksheet and we're going to add that $15,000 to the value of trade receivables that we already have. So that is plus $15,000. And that would give us a total value of $25,000 for our trade receivables based on what we have. Again, let's go back to the question. We have Simone Cook owes 18,000 in bank and 8,000 in her cash register. So what we're getting from this is that bank is 18,000 and cash is 8,000. Let's add this information to the worksheet, and that is bank 18,000 and we have cash, and the cash value is $8,000. And guess what? We're now on to the additional information, and that is very important for us in completing our balance sheet. The first one states interest charges on the loan from Optimum Beverage Financing Limited have not yet been paid for the month of January 2018. What it is saying is that this 20% per annum loan of 60,000, the 1 month amount is not yet paid. January amount is not yet paid. So what we're seeing is that that is outstanding. So the liability, there's a liability right there because that is accruals. So over onto our worksheet, we're going to do our calculation, and that is loan interest accrued of 20%. So it's 20% times the loan value of 60,000 multiplied by 1/12. Why do we do this? We are only ascertaining the value for January, that 1 month period. So when you multiply the 20% of the 60,000, you get a value of 12,000. We just need for 1 month. If it is 12 months in the year, we need for 1 month, so it is 1 divided by 12. Or you could say 12 into 12,000 would give us $1,000 per month. So our total accruals right there is the 20,000 coming from the rent that is owing, and that 1,000 coming from the loan interest. Going back to the question, because there is one more bit of information that we need to pick up, and that is we are seeing that Simone Cook has decided to depreciate the delivery van using the straight line method of depreciation. She expects to get 8 years of service from the van. So the usage is 8 years, at the end of which she anticipates she can sell it for 12,000. So what we're seeing is that Simone residual value, the disposal value, the scrap value is 12,000. You are to account for the 1 month of January. So you are to account for January only. So they want you to include within your calculation that depreciated value for the 1 month. So the first thing we need to do is to ensure that we calculate the depreciation for the year using the straight line method. Because it's a straight line method, the formula is cost minus the scrap value, the residual value, the disposal value, which is basically the value at which the business expect to sell this item for at the end of its usage, divided by the number of years of use. So it is cost minus residual value divided by the number of years of use. So we're going to look at the calculation for that. So we're going to calculate the annual depreciation. It is 140, which is the cost at which the van was purchased for, minus the disposal value of 12,000 divided by the 8, because it is 8 years of use, and that gives us $16,000 per annum. But guess what? We were asked to show the amount for January. So because we're asked to show the amount for January, we are going to determine what is that 1 month depreciation. So we could just simply divide the 16,000 by 12, or 16,000 multiplied by 1 divided by 12. And when you do your calculation, you would notice that you get $1,333.33. But we are asked to round off the nearest whole number. So the amount per month is $1,333. So now that we have finished assessing the information that we are provided with, we can then move into preparing our balance sheet. So let's break this information apart to do our balance sheet. So in doing the balance sheet, people, the first thing that you need to enter is the heading, and your heading reads Simone Cook balance sheet as at 31st of January 2018. We are going to begin with fixed assets. So we need to identify the fixed assets that are in the question. We have for fixed assets, the blender, we have the delivery van, we have the refrigerators, right? But notice that the delivery van has depreciated and the amount for the month is $1,333. We are now going to look at the recording of that information in the balance sheet. So we're looking at the fixed asset section. Just a reminder, once there is depreciation, your columns should be labeled cost, accumulated depreciation, and net book value. So you would pick up the cost for each fixed asset, enter the accumulated depreciation, find the difference between the cost and the accumulated depreciation to get the net book value. Once you have entered all your fixed assets, you would then total your costs column, single line above, double line below for that, because remember, you're not going to use that figure anymore. The very same for the accumulated depreciation. And then guess what? You would continue with the net book value. So therefore, that is not double underlined. So the current value for fixed assets within the business at the end of January is $433,667. So we add the value for refrigerators, blender, and delivery van together to get that total. Now that we have cleared the fixed assets section of the balance sheet, we're now going to look at the current assets section. But let us identify the current assets from our list that we have generated. We have inventory of 50,000. We have the prepayments of 9,000. We have trade receivables, which is 25,000. We have bank. We have cash. We're now going to take a look at that section of the balance sheet. And here we go. Don't forget to put in your title for the section. In order of permanence, we have inventory, trade receivables, prepayments, followed by bank, and then our most liquid asset, which is cash. And again, that is the least permanent asset. Having listed those, you would then total, and we have a total current asset of 110,000. Our next step is to look for our current liabilities. What do we have as current liability in this question? We have the accruals of 20,000, which was the rent that wasn't paid, and we have the loan interest of 1,000, which wasn't paid as well. So let's look at that section in the balance sheet. That's the current liabilities section. Remember, we are subtracting current liabilities, so this should be less current liabilities. And the current liability in the question is the accruals. You're seeing where I have the total accruals. I got that from the rent that was owing and this 1,000, which is owing for the loan interest. So all I did was to combine both figures and enter that. So in the balance sheet, what I could have done is to put this in brackets. So it's 20,000 plus 1,000. For your purpose, you could as well just note that you could have listed rent accrued 20,000, loan interest accrued 1,000. You would still be correct. So if it is that you list them, then you would still be correct. All right. So now that we have the total for the current asset, which is 110,000, we're now going to subtract the current liabilities from that, which is 21,000, and that gave us the value for working capital, which is $89,000. This 89,000 now will be added to our total fixed assets to give us the total of $522,667. So our next step now is to check if we have any long-term liabilities. And from what I recall, we do have long-term liability, and we're going to list that long-term liability. But first, let me identify the long-term liability, and that is the 20% 6-year loan of $60,000. Let's look at that in the balance sheet. So remember, you have to put in the heading long-term liability, and you can indicate that you are subtracting the long-term liability. So you can write less long-term liabilities. The amount is 60,000. This 60,000 is subtracted from the $522,667, and that gave us net assets. That gives us net assets of $462,667. Now, we are ready for the final section of the balance sheet, and that is our finance by section or capital section. We were presented with the assets and liabilities, and we have listed those in the balance sheet thus far. And basically what we have assets minus liability. The value that we have generated is $462,667. Now to calculate your capital that is missing. To calculate your capital that is missing, remember it is assets minus liabilities. And guess what? We have that figure already. So we are practically complete with the balance sheet. Finance by capital, which is 462,667. So remember, your assets minus liabilities give you capital. And this is the value of assets minus liability. And this is what we have entered as our capital. So we can safely say that we have completed May 2019 number 1 question.
Like, share, and don't forget to subscribe.